will share my screen. Are you able to see my screen?
Yep.
Perfect. Awesome. We'll jump right into it.
Okay, welcome everybody. I apologize for my voice. It seems like whenever your child starts, or in my case, daycare, someone's bound to get something. So I will let Sean do most of the talking, but I think what's on everybody's mind right now is, it's been a crazy year so far. We're rounding out second quarter. It's been pretty volatile in the markets. And so Sean, walk us through some kind of indicating factors, some research and data, as you can see on the screen, pulled by JP Morgan, pretty revealing, and kind of shows us maybe what's underneath some of those numbers in the media and what you hear. And then keep in mind that one of the data points that we're keeping an eye on is coming out later this week, the CPI number, so the inflation rate. So we're hoping to see that number go down as interest rates are hiking up. So Sean, I'll let you kind of take it from here and kind of show us what we're monitoring so far this year.
Yeah, absolutely. So thanks, Nora. We are getting a lot of questions. Everyone wants to know what's going on in the economy. When's the right time to get in? Is this going to last for a really long time? Are we bound for a recession? And certainly every time you turn on the news network, that's a great time to get scared, because then you're hearing all sorts of different advice. You've got people saying, no, it's going to be a soft landing from the Fed. And then every other article I see, it says, of course, there's going to be a pending recession. Crypto's going to crash. You name it, it's being pushed out there. A lot of fear in the market. And so what we want to do is just kind of show you a little bit of data behind some of the questions we've been getting. We get a lot of questions on inflation, on what's going to happen with Ukraine, federal interest rates. How are all of these things going to impact the economy? And how are we kind of using that data to make the decisions that we are? So we'll jump in. So first thing is kind of Ukraine, right? How big of a deal is Ukraine? And this chart is important because what it's showing you is kind of the consumer spending on energy and food as a percent of kind of our energy and goods and services over the long term. So going from 59 to 19, you can see that a lot less of our spending is going towards some of these things. Additionally, just kind of looking at the net imports of oil as a share of our GDP, it has gone down drastically really since that 2008 timeframe. So if we don't get imports from Ukraine, if we're not able to get imports from Russia, and for oil, how big of an impact will it have to our GDP? Pretty nominal, right? If we go back and look at kind of the world market capitalization, Russia makes up a very, very small percentage of the world's market valuation. Meaning if every company sold, what would they be worth? Russia has a very, very, very little impact, like less than 1% of all the world market cap. So what's happening over there in terms of energy and all that is really, again, more media being pushed out there. We don't rely extremely heavily on imports of oil at this time. So again, kind of just some good numbers to kind of see what's actually happening behind some of those things. Certainly something to watch out for. We don't really know how crazy Putin will get. And the crazier he gets, kind of the more we may need to get involved, some of those things to impact the economy. But overall, we don't see a huge impact based on what's happening in Ukraine. Another thing is that's still lingering out there is COVID-19. So this kind of goes through the blue line here is showing confirmed cases. The black line is showing fatalities as the 7-day moving average. You can see starting back in February of 20, kind of things spiked, and then they've been decreasing. So we're seeing less and less numbers in cases. At the same time, we come over and look at some of the high frequency data. So the percent change from the comparable week back in 2019. So this is kind of our baseline. And then we saw the market go down in February 20. Again, that was coronavirus happening. So we saw things like consumers' credit and debit transactions, the number of transactions people were making. We saw hotel occupancy go down. We saw seated diners, they were closed completely, so 100% loss during that time period. And then traveler traffic down very substantially as well. So what's showing is that back to 2022, where we're at today, we're starting to see everything kind of get back to normal. So we're seeing less and less impact of COVID on the overall economy, which again is all really good. We've kind of been through it before. We know what works, what doesn't work, or at least we can semi-agree on what that process would look like. And so we're seeing less of an impact on coronavirus and impacting the market. And we kind of compare it to historical records, and we're really kind of getting pretty close to normal, through February of 2022. Another thing is kind of unemployment and wages, right? Everyone's been asking really for the last year or so. All I see is people saying we're we need to hire, we need to hire. That's because we have really low unemployment, right? So if we go back to like the 80s, another time where we saw extremely high inflation in the 70s and 80s, we also had really, really high unemployment. Or we start back in April 2020, again, coronavirus, people were getting laid off. That number has come down very, very drastically. So we currently have an unemployment of under 4%. So an extremely healthy workforce. When we look at kind of things that the Fed will look at to raise and lower interest rates, they really care mostly about unemployment. If they start to raise interest rates and companies start to fire people, then they may maybe not raise interest rates as much. And we saw some things kind of earlier in the month between Target and Walmart. They actually started laying some people off for the first time that they have really since coronavirus, right? Those companies were needed everybody they could get to try and use some of that online demand that they were seeing. So we're starting to see some of that cool off. And so we're starting to see layoffs for the first time. And again, this could all be tied to interest rates. So that's the number we want to continue to monitor is what's happening with unemployment, because that's going to really dictate how aggressive the Fed feels like they need to be. In addition to that, we're also seeing some strong wage growth, right? So inflation is real. People's paychecks are getting a little bit higher. Government employees, military reservists, people that are on Medicare, everyone really got a pretty good bump here in 2022. So we're starting to see those things play out. People are getting a rise in their wages, but also kind of getting hurt at the pump as well, right? In a lot of other places, right? Inflation's real. So that wage growth could be eaten up a little bit by that inflation, but we're starting to see wage growth as well. So hopefully, right, we can get some inflation to temper down, continue the wage growth, keep the unemployment low, still have a really strong fundamental economy. Again, if we go back and look at other times, right, 2009, that was right after the 2008 market crash. We saw the unemployment rate around 10%. Back in 2003, 6%. So we can kind of see some historical data and also understand that we have really, really strong workforce underneath this economy. There's a lot going for this economy in terms of wage growth and unemployment, which can give us a really strong rebound once we can temper inflation. Speaking of inflation, right, this is kind of looking at headline CPI versus core CPI. The black is the core, the yellow is the headline. You really see back in after 2020, the CPI, or Consumer Price Index measure of inflation, really starting to get higher. All right, this kind of went through February 2022, kind of some updated numbers. We saw for the first time in May that inflation started to kind of come back. So in April, the number came out and it was about 8.5. In May, it came down to about 8.2. So that was the first time in the last 12 months we've actually seen that inflation number come downwards. So as Nora mentioned at the beginning of the segment here, we're getting that number released on June 10th at 8:30 in the morning. That would be really good insight to find out, are we doing things appropriately to curb inflation? Is it actually working? Is it plateauing? Are we going to maybe get into the 7% range, or is all of it kind of for naught? I'll tell you, I just filled up my car this morning and wow, was it expensive. So you're still seeing inflation in a lot of different areas. We want to look at the entire economy and find out, are we starting to move the right direction in some of the important areas? So kind of consumer confidence in the stock market. This is what I want to kind of go over, because again, you'll always hear us talk about, right, a lesson from Warren Buffett. You want to be greedy when others are fearful, and fearful when others are greedy. Well, now's the time that a lot of people are fearful, right? So if we kind of go back and look at some of the historical data, right, we look at kind of some consumer confidence in the stock market, right, some ultimate lows, and the percentage below is the subsequent 12-month moving average of the S&P 500. Again, past performance is not indicative of future results, not trying to promise anything there. I want to kind of show you that when people are not very confident in the market, it tends to have a really good outcome. We go back and look at some historical returns of our portfolios. After we have a year where we get a pretty big downturn, we have a really strong incline. Again, it doesn't mean it's going to happen next time, but it's a good time to always buy low rather than try and buy high. Do the opposite of what everyone else is doing. So right now, again, after April 2020, right, again, coronavirus, really low consumer confidence, saw a 43.6% rise in the market. That's because the economy came back a lot faster than we thought. We had a lot of government stimulus that paid off. Now, once again, we're seeing consumer confidence even lower than it was back then. And really, I think that's because we went through a time period for the coronavirus recession. It lasted about 2 months. Okay, so it was really quick, right? We saw this big downturn in the market of about 38%, and it came back really quickly. Well, right now we're sitting here and saying, man, the last peak of the market was like November 17th of 2021. So we've been going through this low and watching our portfolios decrease for the last 7 months now. And we're like, why, when is this ever going to end? Is it ever going to end? Right. And so we always say it's a good time to kind of get in the market. If you've got cash sitting around, if you're a long-term investor, historically, when consumers are not confident in the market, it tends to outperform. So we want to be greedy when others are fearful. So again, just some data behind some of the things that we're thinking: get money in the market, stay diversified, have a solid portfolio that's been through all this before. And hey, we've got a really strong economy. We just have a lot of different variables right now playing with Ukraine, inflation, federal government raising interest rates, and kind of the consumer confidence in the market. So a lot of impacts happening right now in the market, but always a good time to be in it as a long-term investor.
Thanks, Sean. And kind of the golden question I get that we've gotten a couple of times is, have we hit the bottom, right? So if you get that question, what kind of, response, data, information that would you give to someone?
Yeah, so, always, right, I have no idea. Right? And if someone's telling you that they know those things, they're lying to you, right? No one will ever know. What we do know, right, is when the market's been down 10%, 100% of the time, it's always come back to where it was in the past. Now, we don't know when. It may be a 6 months, it may be 6 years, but it's always going to come back as a long-term investor. So while the market's discounted, it's a good time to get in. What I tell people is we got down to about an 18% drop in the S&P 500 just a couple of months ago. And so we're starting to see the market move towards recession-like numbers, a 20% drop, or also defined as kind of 2 consecutive quarters of a GDP decrease defines a recession. So we start to get to those numbers. We may get to that point. Kind of currently sitting through the year, we're around 13% drop in the market with a good rise so far this morning. So we don't know where the market will go. I don't know if we'll get to 20% or below. I have a hard time believing that we'll kind of get down to that 35, 38% drop in the S&P like we saw in 2008, like we saw in the coronavirus, because there was so much uncertainty going on at the time. So while we're discounted today, don't know if it's going to be the low. I don't know if we missed the low. We're probably somewhere right in that region. I can't imagine it getting too much crazier from here.
Okay, thanks, Sean. That's all the questions that kind of came in, questions that we received the past month. If you have any additional ones, or you have some fear, listen to something, you heard something from a friend or something, please reach out to Sean and I. We're happy to be a resource. Our philosophy is all evidence-based, so hopefully that some of this unbiased data kind of reassures you and helps as you continue moving forward the rest of the year. So until next month, please send questions. We're here for you.
Thanks, everyone.